Hello, and welcome to another episode of Investment Banking Secrets. In today's episode, we will touch on credit risk, and we'll touch on three products that are used. Typically, there are many more in the market, but these are the three main ones that are used by investment bankers, especially in the lending space, to mitigate credit risk. And they are credit default swaps, commercial risk insurance, and also export credit agency cover. And you'll come across all three, especially export credit agency cover and commercial risk insurance, if you're dealing in the project financing space. So without further ado, let's hop right in. What is the difference between credit default swaps, commercial risk insurance, and export credit agency cover? Let's first look at credit default swaps, or CDSs for short, and let's look at how they work. You typically get a company, it would usually take the form of a pension fund, that has got a mandate from government or whichever laws of the country that they operate in, that they're only allowed to invest in a certain type of risk, because what they want to make sure is that they want to preserve the capital of their trustees or the people who take out those pension funds with the actual firm. So they're not allowed to invest in highly risky, highly speculative products. They need to make sure that they preserve the capital. So what they want to do is, at the same time, these pension funds want to make sure that they invest in instruments that allow them to outstrip inflation or to exceed inflation in their returns that they make. So this is quite difficult to balance the two, because the safer an investment, generally the lower the rate of interest that that investment would offer you. And if you're a pension fund, you need to constantly be looking over your shoulder to see what the inflation rate is and to make sure that you're constantly exceeding this inflation rate. So how do they do this in practice? How do they maintain above inflation returns, but at the same time making sure that they don't invest in highly risky assets? Well, one way that they can do this is by using a synthetic method of credit protection, and this takes the form of a credit default swap. So let's see how this works in practice. So you'll get a pension fund A that's seeking high yield, but because of their mandate, they can't invest in speculative or risky investments. So this would be sub-investment grade investments. So your investment rating is summarized in a rating scale, which we cover in the mining finance course, and I think we also covered it in the webinar from 2 weeks ago. Basically, this rating scale summarizes the probability that this company will default on its debt. So pension funds have a mandate that they need to only invest in safe companies. So speculative grade is sub investment grade, double B plus. Anything pretty much below triple B plus is speculative grade, or it's a sub investment grade, to use the right terminology. So this pension fund is left with a bit of a dilemma, because let's just assume in South Africa, for instance, inflation is targeted at between 3 to 6%. And let's just say that a government bond, which is highly secured, yields about 6%. So you're not really exceeding inflation, or even if it was 7%, you're not exceeding inflation by much. Let's assume other things in your portfolio underperform. And unfortunately, then your investors don't get that return or that annual growth on their pensions, and they won't necessarily be able to retire as comfortably as they would have hoped to, because their invested funds are not constantly outstripping inflation by a large enough margin to give them that windfall when they retire, or that guaranteed income that will exceed what the cost of living would be in the future. So what the pension fund could do is, the pension fund could then look to these sub-investment grade assets, and you have this corporate double B plus that issues a loan into the market, and you could just describe that as a corporate bond. And what pension fund A would do is they would subscribe for this corporate bond. Now they're left with this dilemma, in that this company is sub-investment grade, but they could synthetically transform this debt of corporate double B plus into investment grade debt. And how they would do that is they would take out a credit default swap on the debt of this corporate. They would enter into an agreement with this insurance company where between the pension fund and the insurance company, they agree that if this corporate were to default on these debt obligations, then the insurance company would pay the pension fund the face value of the debt. So let's just assume that this pension fund took out a $100 million loan from this corporate, or subscribed for $100 million in corporate bonds from corporate BB+, and that's their corporate bond rating, BB+. The pension fund then takes out full 100% cover on the face value of that bond. So they take out $100 million worth of insurance cover. And let's just assume that this insurance company is rated investment grade. So now that you see, this pension fund has effectively transformed their risk from the risk of a BB+ corporate to a risk of an investment grade insurance company, in that if the corporate defaults, the insurance company will make this pension fund whole. So the pension fund has just transferred risk from this corporate to an insurance company. So they're still technically well within their mandate. They can still justify this investment to their trustees or their pension fund holders to say that we are only investing in investment grade counters. In return for that, this pension fund would need to pay a premium to the insurance company. And by paying the premium, this insurance company would then assume the risk of corporate BB+ defaulting. So let's just use some numbers. Let's assume that the interest rate on this corporate bond is 10% per annum, or the yield to maturity is 10% per annum. Let's assume that it was bought at par. You could just say a coupon of 10% per annum. So let's assume that every year this corporate pays the pension fund 10% of $100 million, which is $10 million. But the pension fund needs to pay an insurance premium because the insurance company has assumed the default risk of this corporate. And let's assume that after running their models, the insurance company comes to the decision that a $5 million insurance premium per annum is fair. So what you'll see happening is then the insurance company will pocket $5 million in premiums, and then the pension fund would just keep the remainder of the $5 million of the coupon. So this makes sense if, for instance, the inflation rate is only 3%. Then this pension fund has gotten a rate of return of effectively 5% per annum, which outstrips inflation, but at the same time represents investment grade risk. So if this is the US, where your treasury bonds or treasury bills are yielding 0.1%, roundabout in the 1 year mark, you're not really going to outstrip inflation, depending on what your views on US inflation actually are. You're much better off entering into a solution such as this one. So let's read what we said here. So a credit default swap is a derivative contract that pays the holder upon the default of a counterparty. Okay, so the counterparty is typically referred to as the reference entity. So we call this corporate BB+, we call them the reference entity. And the derivative, which is the CDS, will pay the holder, in this example, the pension fund, the derivative will pay the holder a payout if the reference entity was to default. The writer of this derivative is then the insurance company in this example. Note, these credit default swaps can also be used by speculators. So let's just expand this example. We have a hedge fund. The hedge fund does not hold any of the debt from this corporate BB+. But yet they take a view that they don't view the prospects of BB+ in a bullish manner. So they believe that BB+ will default pretty soon. Because that's their view and that's part of their strategy in this hedge fund, they want to take out some sort of a financial instrument that will pay them upon the default of corporate BB+. Well, there's no better instrument than a credit default swap. What they can do is they can then approach the insurance company, or any bank for that matter, because banks are also market makers in these credit default swaps. So they can either approach a bank or an insurance company and take out insurance upon the event that this corporate BB+ defaults. If this corporate defaults, then the insurance company or the bank would then pay out a certain sum of money depending on the extent of the cover that the hedge fund took out. So in this example, even if this hedge fund didn't own any debt in this company, let's assume the hedge fund took out $100 million worth of cover on corporate BB+. If BB+ was to default, then either the insurer or the bank would pay them $100 million upon the default of that corporate entity, even if they don't hold any of the actual debt of that corporate entity. And in return, this hedge fund would make periodic payments of premia to either the insurance company or the bank, depending on who they took out the CDS with. Okay. So in other words, it can also be used by speculators. The hedge fund does not own any of the debt, but they're speculating. What if this corporate was to default, which is part of our strategy, and we want to pay out if they do default? And we saw Goldman Sachs guilty of this during the global financial crisis. So the buyer does not need to own the underlying bond. And this is also what's referred to as the basis trade. So if you want exposure to the default risk of BB+, in other words, you want credit exposure to BB+, there are two ways to do it. You can either look at the CDS market, or you can actually buy bonds in this corporate. So the first strategy was employed by Pension Fund A. They actually bought the bonds from this corporate. Another strategy, if you believe that it's well within your mandate to take the credit risk on that counterparty, you would need to weigh up whether it's advantageous for you to actually buy the bonds or just enter into credit default swap. So what you can do is, instead of buying the bonds, you can just enter into a short position in a credit default swap. What does that mean? What that means is, if this company was to default, you would then pay somebody else the face value of their debt upon a default. Okay, so you're parting with money if that counter was to default. Now, doesn't that resemble your position when you are holding a corporate bond? If the counterparty to that bond, or the borrower of your money, defaults, then you've effectively parted with your principal, the amount of money that you invested in the beginning. So by going short a credit default swap, you're mimicking the position in a corporate bond. So you go short. In return for you assuming that risk, in return for you assuming the credit risk of that counterparty, you then receive the premiums. So what you need to do is you need to compare like for like. You're achieving the same thing whether you buy the bond or whether you hold a short position in the credit default swap. If you hold the bond, you receive the coupons. If you hold the credit default swap, you receive the premiums. So one thing that you need to do is you need to just compare the two. Are the coupons greater than the equivalent premium for the same counterparty? If the coupons are greater, then invest in the bond. If the premiums are greater, invest in a short position in the credit default swap. And that's just referred to as the basis trade. So with credit default swaps, if you are a lender in a lending consortium, you can do this in private. So let's assume that you are investing in a company and you are providing them with funding. And it's not only you in this lending consortium. There are two other lenders, for example. You don't have to disclose to those two other lenders that you have bought debt protection. You don't have to disclose the fact that you're holding a credit default swap. In case your borrower defaults, you will get paid under this default swap. You don't have to tell anybody. That can be done anonymously and confidentially. So that's another feature there. So we'll see towards the end of this presentation how that could be a good thing, but it could also be a bad thing. I'll just tell you why it could be a good thing. If you are entering into a club deal or deal where you're offering a client a lot of money, and the amount of money that you're offering this client in the form of debt is too much for you to hold on your individual balance sheet. We covered this in the webinar 2 weeks ago, how banks optimize their balance sheets. I recommend that you check that out. I think that's episode 3. If you can't hold all of that debt on your balance sheet, what you'd want to do is you'd want to sell that debt off to somebody else or share that risk among all the lenders. So Typically, what banks would do is they'd want a lead arranger, which would be the bank that's in charge of the lending consortium. So let's say that there are 5 banks, or in our example, 3 in the lending consortium. They just want to deal with one head bank or one lead bank. Negotiate with a lead bank, and then the lead bank would, their job would be to then convince the other lenders to go along with what the negotiated position was. So in that case, typically your clients want the lead bank to hold a majority of the exposure within that lending consortium. So when you agreed to be mandated lead arranger, or MLA, you told the client, okay, it's a 3-bank deal, but I'm going to hold 50% of that debt, and I'm going to subdivide the remainder 50% between 2 other lenders, so they'll each get 25%. But it's a show of commitment to the client that I'm committed, I believe in your business, and I'm the lead bank here, so I'm holding a majority of the exposure. Now, your credit committee will turn around and say that's too much exposure for our balance sheet. But you've got a client relationship to maintain. So what you'd do is you'd go to the credit default swap market and you'd buy protection up until the level that your credit committee is comfortable. So maybe you'd take a credit default swap on 50% of your exposure. So in reality, all of the lenders in the consortium are holding 25% risk to this client, but 25% is being held by market makers, or the banks have already traded it out to other clients who are mainly speculators or chasing yield. So the benefit of doing it anonymously is the client, in their eyes, they still see you as the lead bank and they still see you as believing in them. It sounds like emotive language, but that's the way these things work. You know, you're dealing with people, not necessarily dealing with computers. So the perceived loyalty of your firm or your bank to the client by holding such a big position, it would stand you in good stead to win ancillary business, M&A activity, hedging, all sorts of ancillary business, because this company who's borrowed money from you says, okay, this is the lead bank, they're my relationship bank and they believe in me. I want to do this transaction. Let me first approach them because they're my lead bank. They're loyal to me. Let me be loyal to them. And this is a big consideration when you are in doing this in practice. So when you do this debt management or risk management synthetically, you don't have to disclose it to the other partners in the lending consortium, and you don't have to disclose it to the client. So in the client's eyes, you're still the lead bank. And also within the lending consortium, you have got what's called a veto or majority lender position, because the majority lender position is calculated based on the exposure that you have to the client, and you would not necessarily need to disclose that you've sold off your exposure in the secondary market. So according to the legal documents, you still hold 50% of the exposure, and maybe you only need to bring one more lender along for you to get a majority lender decision. Or if your legal agreements are phrased such that if you get 50% or more of the votes, then that decision is taken. So for those reasons, you'd want it to be anonymous. Under these credit default swaps, you pay your premiums upfront, and you also pay a periodic premium. So how it works is you've got an upfront payment under a CDS, but you also have periodic premium, and the periodic premium is pretty much market standard. It varies from market to market. I've heard that it's either 100 basis points or 500 basis points. I myself am not a trader in this, but the theory is that it is a uniform rate subsequent, so the subsequent premiums that you pay. But the upfront premium that you pay is risk adjusted, and this measures the difference between, say, taking out a CDS with corporate BB+, corporate BBB, and corporate B+. That would be reflected in the upfront premium that you pay. So that would be risk dependent. And then the remainder of the premiums would be all market standard, and they would be either 100 basis points or 500 basis points is the intel that I'm getting. Upon default, the defaulting bonds are put, or they're delivered to the right of the CDS, or the CDS is cash settled. So let's break that down. Corporate double B plus defaults. This CDS is almost as though you have a put option on the full face value of the debt at par value. Okay, so you have a put option which gives you the right to sell this debt. Okay, the right to sell this debt to somebody at full face value, and you're going to exercise that put option. So that means that the person on the other end of that put option is obliged to take that debt from you at a fixed price that you agreed to in the past. And what was that fixed price? It was just the face value of the debt, so $100 million. So upon a default, you exercise that implicit put option and you deliver the debt. Remember, under a put option, you receive cash and you deliver the asset. So you deliver the debt to the insurance company because that's the writer of this put option. And in return for delivering them this debt that's now defaulted, so they become the beneficial owner of that debt effectively. So they step into your shoes. You've swapped again with them. Okay. And then they pay you the face value of that debt. So your loss is therefore zero. So if you look at the net effect of that transaction, just because the bond is defaulted does not mean that it's worth zero. In the CDS market, they have auctions and they auction debt or bonds that are already defaulted. And we'll cover this when you do a settlement of the cheapest equivalent. Basically, they'll give you options. You can either deliver the actual defaulting counterparty, or you can deliver the cheapest bond that mirrors its characteristics closest. So if there's a similar counterparty that's also defaulted, same industry, same default risk, you can deliver that bond as an alternative to delivering the initial bond that you bought protection under. Okay. So what that achieves is, at the end of the day, you're delivering an asset that's been marked down significantly. So let's assume that it had 100% or 100 par value. After it defaults, let's say it's only worth 60. Okay. So you've automatically made a loss of 40% on the face value of that bond. Under your CDS, the insurer is still going to pay you the 100%. So they're still going to pay you 100. But in return for paying you 100, you're going to transfer ownership in the bond to the insurer. And the insurer now holds a bond that is now worth 60% of what it was worth previously. Okay. So the net, if you think about it, the net, you're giving away an asset worth 60 and you are receiving 100 for that asset. So the net payout is, you either do it the long way, you deliver the asset worth 60 and they pay you the face value of 100, net 40, or they can just cash settle you the 40. And the 40 is calculated by saying the notional principal, which is 100, times by 1 minus the recovery. So in our case, after the bond defaulted, it was still worth 60% of its original value. Okay, and we cover what events of default are extensively in the mining finance course. That's the topic of a separate webinar if we do one on that. But an event of default does not mean that the company has gone under, it's been liquidated, and it's no longer in operation. Okay, there could be certain restructurings, there could be a missed covenant, there could be a whole host of events of default, which we do cover extensively in the course. So basically what you want is the net effect, whether you choose to deliver the bond to the insurer or whether you choose to just have the net settlement. And the net settlement will just be the notional principal multiplied by 1 minus the recovery. 1 minus the recovery is also referred to as the loss given default. Okay, think about this for a second. The loss given or conditional upon, so you have experienced the default. What is the loss? In our instance, we said that the minute you defaulted, the bonds lost 40% of their value. So the LGD was 40%. So 40% is equal to 1 minus the recovery, and the recovery was 60%. So your payout was just the notional principal times by 1 minus the recovery. Okay, whether you physically settle or whether you cash settle. And the next point is, if there is no event of default, then you do not receive a payment under the CDS. So basically, the CDS is like any normal insurance policy that you have for household, for your car. You don't want anything bad to happen. And you're happy if you don't call on your insurance policy. So if nothing bad happens, the insurer, under ordinary circumstances, won't say, here's a payout, nothing happened. No. If nothing happens, you don't get any payout from the insurer. And then the last point is can cause contagion in financial markets, leading to too big to fail situations for banks and insurers. Okay, so let's just unpack that. What happens if something goes wrong in this picture here? What happens if, let's just do one example. What happens if this insurance company suddenly loses its investment grade rating? Wow, then this pension fund is in big trouble because the pension fund is no longer within mandate. The pension fund can only do business with investment grade counters. And now that this insurance company is no longer investment grade, then this policy is then null and void. So this policy is null and void. And then what happens to this debt? Now the pension fund is scrambling to find another insurer in the market. But what happens if this is happening to all the other insurance companies too? They're also losing their investment grade rating. Maybe they're not adequately capitalized. Okay, we saw this in the subprime mortgage crisis, or the great global financial crisis in 2008. So basically what the government has to do is they need to step in and guarantee the debts of these insurance companies, just to make sure that these insurance companies maintain that rating so that that panic does not occur. Okay, too big to fail. Another example is what happens if all of these corporates start to default. Okay, what happens is these banks are market makers. They have to provide a buyer for every seller and a seller for every buyer. They have to. That's their job, market makers. If all of these entities are defaulting, everybody wants to buy protection. Nobody wants to sell protection. So these banks are left with all of this exposure and they're trying to get rid of it. They're trying to pass it off to other banks. Other banks are saying, no, we're full up. We can't buy any of your exposure because everybody's defaulting. We can't buy exposure to defaulting companies. So another panic ensues with all these banks trying to sell off these credit default swaps to each other, but nobody's buying. That causes another panic in the market. So again, the government steps in to bail out the insurance companies and the banks. And this is, it's all based on your opinion, whether you believe that in 2008 the right thing was done by recapitalizing the banks and the insurance companies at the expense of the individuals, replace the word corporate with just average Joe Soap, average citizens who were going to be foreclosed on their mortgages. And I heard a very interesting commentary on that it would have cost the government far less to just buy the individual homes from the homeowners and make sure that the homeowners don't go bankrupt or don't become homeless. It would have cost the government less to adopt that strategy, but the justification of that was it would have caused a moral hazard. So in other words, people would take out home loans, but they'd know that if all goes wrong, the government is just going to buy the house from me and I can still live in this house. Well, contrast that with what the government did with the investment bankers. If the government bails out an investment banker, doesn't it also cause moral hazard? And it seems as though us millennials are just hopping from one crisis to the next. So that's your opinion. I'd be interested in what you think about that. You can leave a comment in the video or in the LinkedIn group. What's your opinion? Do you think the government did the right thing in 2008? And now we have this US government with large stimulus packages again going to corporate entities and not necessarily directly to individuals. Depends on what your belief on government-backed digital currencies are, but that's appears to be a long way away. But for now, it appears that the bailouts are going to the corporations again and not directly to the people. So you can leave me your opinions and your comments. I'd be interested in reading those. Okay. So as we see, oftentimes these credit default swaps, or not oftentimes, especially in 2008, caused this contagion in the market where certain corporates, such as insurance companies and banks, become too big to fail. If they fail, then the whole house of cards collapses. And depends on your opinion. Where should the stimulus go? Should it go to the end users, or should it go to those corporations? Okay. Part 2, commercial risk insurance. So for a commercial risk insurance policy, premiums are paid periodically throughout the life of the policy, usually in advance. Okay. This just works like an ordinary insurance policy, really. It's very similar to the credit default swap. You pay an insurer a premium, and the insurer insures you against the default of a counterparty. Okay. So you pay your premiums periodically throughout the life of the policy. It differs from a CDS, and a CDS usually have a large payment up front and then a market determined premium throughout the remainder of the life. For commercial risk insurance policy, your premiums are uniform. And they can be entered into confidentially or openly, okay, on behalf of all parties or funders. So again, going to this point of entering into your insurance with everybody knowing about it, or doing it secretly. You have that option for commercial risk insurance. You can adopt either strategy, and we'll see what some of the drawbacks of being anonymous are right at the end. You can't use commercial risk insurance speculatively. Okay, you actually have to hold this debt. So that's a main difference between CRI, commercial risk insurance, and a CDS, credit derivative swap. For these insurance products, they're only going to insure you if you are noted in the legal agreements and you actually are a holder of that debt, and we'll see why, because this is very important. In the next point, insurers are usually involved in lender matters. Okay, so you can't be a speculator here. You have to actually have rights under the loan facility in order to insure that loan facility. Okay, why? Because the insurer will then stipulate that if you have a vote among the lending consortium, maybe the borrower wants to change the way that they are paying interest. So instead of paying interest semi-annually, they want to pay interest quarterly from now on. So that needs to go to a vote. All the lenders need to decide, okay, are we going to allow this, or are we going to block it? And your insurer wants to be involved in that vote. So if it's an all lender decision, such as an example, changing the interest period is an all lender decision. You get majority lender decisions and all lender decisions, but changing the interest period is typically an all lender decision. Your insurer will say, if it's an all lender decision, you need our consent before you put in your vote. Okay. So the insurer also has a lot riding on this, and they want to minimize their own losses. So they want to make sure that, first of all, you are a legal signatory to that loan agreement, that you do have the right to actually vote. And second of all, when you vote with my interests at heart as well. Okay. So this is why it's important that you can't use these things speculatively. You actually have to be a recognized lender of note. Upon default, insurer assumes the risk position of the insured, and in return for payout under the policy, similar to a CDS, so exactly the same way, when the counterparty defaults, then the insurer will call it a subrogation. What the insurer will then do is the insurer will say, okay, we will give you the face value of your debt, or the sum assured, the sum insured. This is how much insurance you bought cover of. Maybe you bought cover on a certain percentage of the debt, not the full debt. We'll give you whatever the insured amount is. And then in return, we want to be now a reference party. So now the curtain gets pulled back, and the insurance company is now a lender of record. So then your anonymity dies after an event of default. Okay. Only cover default arising from commercial risk and not political risks. Okay, so commercial risks is, let's assume that it was a mining project, and they didn't build the project on time. There were cost overruns. They didn't build it according to specification. There were defects. And cut a long story short, you ran your financial models, and unfortunately this business is consistently underperforming. And again, as I mentioned before, an event of default is not necessarily saying that you foreclose and you then auction all the assets and everybody just walks off into the sunset. It could mean that this mining company still carries on after it's restructured, and you can go through what's called administration, or in South Africa it's called business rescue. It's called bankruptcy. There are various names for it. But basically, what you do is you appoint somebody, a business restructuring practitioner, business rescue practitioner, or administrator, to go into the business and see how they can restructure things such that the business is sustainable going forward. So, in that case, the insurance company, okay, the company's defaulted. The insurance company has paid the banks off, the banks walk away, but the insurance company is now a lender of record. And the insurance company then says, okay, business rescue practitioners, restructure this thing and let's see if I can make any recoveries over the next 5-10 years. Okay, so default is not necessarily the end of the world. But these CRI, commercial risk insurance policies, only cover commercial risks. So that is, as I mentioned, defects. That's if it's a mining company, the commodity price just tanks. And, if the gold price tanks and these gold miners are no longer profitable, then they have to close up shop. And in which case you'd call on your commercial risk insurance, and the insurer would then step into your shoes, pay you the face value, and step into your shoes as a lender of record. And then they would perhaps sit on this mining asset until it could be revived in the future when commodity prices tick up again. Okay. So it does not necessarily cover political risk insurance, PRI events. Political events are government expropriation, the national currency losing its value or not being tradable, like sanctions, such as Iran, for example. It's very difficult to use their currency internationally because of sanctions. War, terrorism. So your commercial risk insurance won't pay out under these events. However, you can top up a CRI policy with a PRI policy, but at additional cost. Okay, it's just going to cost you more. And it would typically be the same insurance company would give you a comprehensive policy with commercial and political risk insurance. So the last thing that we'll do is touch on export credit agencies. Okay, so remember, all three achieve the same thing at the end of the day. It's just de-risking a deal. So an export credit agency, or ECA, provides insurance to lenders for the default of a borrower, okay, usually a foreign importer of locally produced goods. So let's just say that a bit slower. Basically, your ECA, their mandate is to try and stimulate their economy. So we have an ECA in South Africa called the ECIC, and their mandate is trying to stimulate the economy of South Africa. And how do you do that? By stimulating foreign direct investment. How does that happen? Well, if you have manufacturers in South Africa, manufacturers want to export their goods, and companies want to export their goods and services. So what the ECA does, there are two sides of that transaction. South Africa exports to a foreign country. The ECA says, I will guarantee the debt obligations of the foreign entity. So in other words, this foreign entity is importing equipment from South Africa and they can't afford to pay for it all upfront in cash. So they would then get a bank loan. The importer would get a bank loan and say, banks, lend me money because I want to import goods from South Africa. So that bank debt would be covered by the ECA. And the ECA would want to do that to facilitate the exporting of South African goods to foreign importers. Okay, so the ECA would provide insurance to the lenders, the banks, that are lending money to this foreign importer. It would provide them with insurance in order to stimulate these local manufacturers being able to export their goods overseas. And you generally see that ECAs play a vital role, especially where country risk is a big problem. So ECAs are usually government backed, and have a mandate to stimulate local economies, and therefore may be able to take risk positions that commercial insurers are unable to take. Okay. Under an ECA transaction, especially in South Africa, you usually pay your premiums up front. So if it's $1 billion transaction and the South African company is exporting $1 billion worth of goods, you take the insurance premium, and let's say the insurance premium over the life of that transaction, the present value of all the premiums is $100 million. You would then increase the loan amount from 1 billion to 1.1 billion. And then on day one, the 100 million would go to the insurer, and the 1 billion would go towards the exporting of whatever goods that you needed to export. So you pay all your premiums on day one, and you can capitalize it, making the loan go from 1 billion to 1.1 billion. Upon a default, the ECA would assume the position of the lender in the defaulted company in return for a payout under the ECA policy. So exactly the same as what we've seen before. So if the importer that imported the South African goods and services now can't afford to pay, they default. The ECA would then say, okay, all the international banks that lent money to this importer, I will make you whole. I'll pay the face value of the debt. In return, I want to be a lender of record. So now the Export Credit Agency faces this foreign importer. Okay, and because these export credit agencies are government backed, they do have a lot of clout and a lot of influence. So you could see that the banks, maybe if it's in a country that's not well known or doesn't have very well developed legal systems, those banks would have a problem attaching assets of the importer or recovering under that loan. But because they're covered by an ECA, it's now a situation where it's government to government. And the ECA has a lot more influence in that regard, and the ECA can make better recoveries in that situation. So once these banks have called on the insurance policy that is part of this ECA transaction, the ECA would then say, okay, I'll make you whole, and then I'm now lender of note. But what would typically happen is the banks would still be involved for the remainder of the deal life, but they would only fill an administrative function. So the importer, whenever the importer sends an email, they would send it still to the banks, and the banks would just need to disseminate the email to the insurance company. Even if the insurance company holds the actual financial risk, the banks are just an administrative function, because typically the ECA does not have that infrastructure. It doesn't have the people who are doing the interest calculations. So it would still rely on the banks to do all of the admin work for them. But the ECA has paid them the face value of the debt and said, okay, you are now de-risked, but just do me a favor. Just whenever there's an email, make sure I receive it. All of the admin regarding amendments to the legal documentations, just make sure you process that on my behalf, because I don't have that infrastructure. So it's a partnership agreement. I think the most important thing for these ECA agreements is they can't be done anonymously. So where you saw the previous two examples where you could do it without the other lenders knowing or without the client knowing, ECA, everything has to be out in the open from the get-go. And this is a very important difference. And we'll see why in the next slide. But the last point is ECA policies cover political risks in addition to commercial risks. Okay, so quite comprehensive. And again, as I mentioned, they're very useful for countries that have a high degree of political risk, developing countries. But the local government wants to encourage export of locally made goods. So they want to encourage foreign direct investment. So they start these export credit agencies to facilitate that. And the main risk there is covering political risk. Okay, so let's look at some points to consider. We previously defined the loss given default. So that's, now this company has defaulted. How much do we lose given that they've defaulted? We've defined that, and we've also defined the recovery rate. So the recovery rate is just 1 minus the LGD, or the LGD is 1 minus the recovery rate. They're just inverses of each other. So the LGD is affected by the type of industry. In other words, the loss that you're expected to incur is dependent by the industry that your reference entity is in. So some industries are more robust, so you've got a higher chance of recovering under your loan than other industries. If the industry is, say, a government-backed mine or power station, because you've got the state there, you could potentially recover 100% of the value of your debt because the state can just raise taxes and use those taxes to then make the banks whole. So your LGD there is close to zero. Your loss, expected loss given default, is close to zero. You might have to wait a while. So maybe it's not zero, maybe it's 5-10%, because you might have to wait for a while. But because government is backing it, like a state-owned power producer, the state does not want to have a power station repossessed, okay, by private lenders. So typically they'll make you good on your debt. But other industries like hotels, and we can see the world that we're in today. It's almost binary. If you have a hotel chain that's gone out of business, what are you going to do? They're using certain hotels as homeless shelters in the US. So that's just anecdotal evidence to see. I don't know how the hotel owners are making any money in situations like that under a hard lockdown. But there, your loss given default is quite high. It either works or it doesn't. Okay. Another point to consider is the percentage sum insured. Avoid a tail wagging the dog situation. So this, all that means is if you've insured 5% of your debt, bear in mind now the insurer in their policy has said you need to act at all times to protect our interests too. And your interests and the insurer's interests might not necessarily be aligned. So for a bank, banks want to churn capital. So if this company is not doing well, the bank needs to make sure that they make a decision quickly because they've got short-term deposits. So the bank would much rather liquidate this company, cut the losses now, than to keep this thing going for a long time. But maybe an insurer has a longer-term horizon, 20 years, 30 years. Okay, and the insurer doesn't actually mind sitting on this debt if this company is barely servicing interest, but the insurance company has a view that, no, this will turn around. Whether in 5, 10, 15 years, it will turn around. So we are against a liquidation. So can you see that if a liquidation is an all-lender decision and you need the insurer's consent, the insurer is going to say, no, we don't want the liquidation. But the banks would, because they want to stomach the loss now and just move on. Okay, get as much, even if they recover 20 cents in the dollar, recover what you can and move on. Okay, so you want to avoid a situation where you've got 5%, 10%, 15% of your debt insured, which is too much to walk away from, especially if you're thinking of you're only going to get a recovery of 20 cents in the dollar. Okay, we cover this in the mining finance course. It's a trade-off. You're only going to get 20 cents in the dollar under liquidation, but you're going to get full face value on, say, 15% on your debt under the insurance policy. So you just have to do the mathematics and weigh up. But usually you end up listening to the insurer if the loss under the insurance is greater than the loss under the liquidation. And you act in ways that are not necessarily ways that you would have acted if you were uninsured. So you just need to make sure that the sum insured is big enough such that it's worth it at the end of the day. So that's what that point is telling you to do. And think twice about insurance if it's a complex deal requiring much lender attention, because you always have to go back and forth asking them for consent. And it can be administratively intensive and you can make a lot of mistakes. And if you make a mistake under your policy, you could void your policy. So if it's a complex deal, maybe think twice about insurance, maybe rather get ECA cover or synthetic credit default swap. The liquidity of the debt in the secondary market and the liquidity of the insurance market. If the insurance market is not liquid, you're going to get terrible premiums and you might not necessarily want to do that. You're going to get terribly high premiums. And you might also get a situation where you can't get the amount of insurance that you want because nobody's willing to take that debt. It's just illiquid. Okay. You also need to balance that with other ways of de-risking, which we cover. Syndication, and that's at the outset. How many partners you have in the deal from the outset? Do you take 2, 3, 4, 5 lenders at the outset, or post the fact distribution? And those considerations are also covered extensively in the course. So you want to make sure that you are making the best decision for your organization given the amount of risk that you are assuming. Okay. Alignment of interest, and this is the most important point out of the entire episode. Alignment of interest within the lending consortium. So ECA policies are by their nature known to all parties, causing alignment and uniformity in decision making. So we talked about the benefits of remaining anonymous, not declaring that you have got a CDS or that you have got an insurance policy. Okay, we talked about the benefits. What are some of the drawbacks? So, misalignment of interests. You have a lending consortium and nobody's playing open cards with each other. Everybody's guarding their cards close to their chest. And it might cause certain lenders to act in a way that would be detrimental to other lenders that are uninsured. If a lender is insured, then they might not want to try as hard to salvage a deal, to put in additional equity, if they know that they're just going to get paid out 100% face value on default. So why should they try harder? But the uninsured lenders think to themselves, wow, the amount of loss that we'll incur if we just give up now is huge. So let's try and keep this going. Now, if all the lenders are either insured or uninsured, they will all behave more or less with the same incentive structure. So it won't cause infighting amongst the lending consortium. And a unified lending consortium is best for everybody, including the borrower. You'll get decisions that are much more fair and much quicker turnaround time, less time and hassle spent on legal conflicts or legal negotiations if you have a unified lending consortium. So oftentimes the whole thing about playing open cards might actually be more beneficial, meaning that the ECA way of doing things where everybody knows, okay, we do have insurance. It's out in the open. So we can have an open discussion as to what do we do next in this situation. Do we put in additional cost overruns to make sure the project is completed? Or do we just walk away knowing that our insurer will pay and then it'll become our insurer's problem? Rather than having one lender that's insured and another lender that's not insured and it's a 50-50 deadlock. Or two that are and two that aren't, and it's a deadlock. And you have to spend weeks and weeks and weeks negotiating, and it becomes hostile. And at the end of the day, you're bleeding money every day, but there's just no making any headway because it's just deadlocked. So oftentimes this anonymity is not necessarily the best way to go, but it has its pros and cons. I hope you enjoyed today's episode. Please leave any comments and any feedback in the comment section, and like and subscribe, and I'll be doing this quite regularly. And join the LinkedIn group. I'll also leave a link to the LinkedIn group below. And yeah, I look forward to interacting with all of you and wishing you all the best, and see you next time.